I've got Robert Sinclair Jr. this morning, Senior Manager of Public Affairs at AAA Northeast with us. Robert, good to have you with us. Let's talk crude higher as we get set for the open here this morning and as we prepare for what appears to be an imminent ground invasion into Gaza.
Yeah, like you say, though, crude has been sort of bound within a certain range. We were as high as $90 a barrel back on October 1st and down to 83 and back up to 85, if I'm looking at the numbers correctly this morning. It has to do with the fundamentals of supply and demand. There is plenty of crude oil around, and with the United States producing nearly 13 million barrels per day, that goes a long way to helping the situation in our country. As we have seen with gasoline prices, they are continuing lower, as you mentioned. We're at $3.62 today, down 12 cents in a week, and down 22 cents in the last month. And this despite all this major action happening in the Middle East.
Yeah, it's interesting to see how the markets manage to turn the other cheek. I like, again, the reminder that it does ultimately tie into the fundamental, the supply-demand narrative that we talk a lot about here as well in terms of, it's not just about price, right, in terms of the charts, but talk to me as far as that goes, that demand narrative that we've been seeing. One of the things we continue to tie it into is very strong labor conditions here in the U.S., and we continue to see that playing out. Just last week, Friday, the jobs report impressing in a big way.
That's right. Americans have shown themselves unwilling to buy expensive gasoline. And what do we mean by expensive? Well, we've done surveys at AAA, and 40% of drivers said $3 a gallon is the pain point for the price of gasoline, that they'd have to cut back in some other area of the family budget in order to pay for gasoline. That survey, original survey, was done in March of 2018 during a much better economy. Last year, we revisited the survey, and we found that 60% of drivers said $4 a gallon is the pain point. And not surprisingly, 75% of drivers said $5 a gallon is the pain point. But look, if 40% say $3 a gallon is a pain point, and we're at 362. There's a lot of drivers out there who are suffering and just do not have the elasticity in their budgets to pay for gasoline prices that have been fluctuating as wildly as they have. Another key indicator is information from the Energy Information Administration that talked about gasoline demand in the last week that they did a survey, and it was 8 million barrels per day. That is extremely lackluster demand. Consider a year ago, the number was 9.5 million barrels per day, and gasoline was 29 cents per gallon more expensive back then. So we've got cheaper gas, but lower demand. Americans are not having it. They have a very strong tool in moderating gasoline prices, and that's not driving a lot. And we're seeing that playing out right now. Yeah,
we've been following the comments from the EIA very closely, the inventories as well, the IEA, OPEC, also a busy week for energy traders to that point here, and maybe somewhat conflicting reports and comments from the agencies, but also that's maybe added to what you were talking about earlier in terms of price being relatively contained. Talk to us about what's behind this divergence that we're seeing. Why are gas prices remaining relatively low relative to crude?
Well, we've got a couple of things going on. Number one, we've seen the switch over to winter blends of gasoline. A lot of people may not realize it, but summer gasoline is radically different from winter gasoline. During the summer, you have the problem of the evaporation due to excessive heat, and that creates volatile organic compounds, and gasoline is blended differently during the summer to take that into consideration. Heavy metals removed, nickel, cadmium, cesium, but there are different blends that are used around different geographies around the nation, and they cannot be shared. So that creates extra costs as far as the refining is concerned and as far as distribution. Mid-September, we make the switch to winter gasoline. During the winter, carbon monoxide is the problem, and gasoline is blended differently, but it's a lot easier to blend, and it's one standard blend, or there might be different blends that are used around the country, but they are standardized and can be shared. So that winter gasoline is cheaper than during the summer, and of course demand goes down. During the summer, probably 80% to 85% of those that take a summer trip are driving to their destination, going somewhere in our big, beautiful country. So that leads to a lot of demand. But again, this summer was very, very different. We did not see the extremes of demand that we would usually see during a busy summer. We're moribund in the 8 million barrel per day range, getting over 9 million barrels per day. A few weeks, but not many during the summer. And so that demand goes down, when we get after the summer driving season, which the end of which is signaled by Labor Day. So those two factors are playing into the price of gasoline continuing to come down despite the volatility of crude oil.
I like it, Robert. Two separate products, right? Very closely tied in terms of the discussions that we have, but different in terms of price activity as we're seeing and in terms of the narrative in many ways. Now, when I look at crude prices, I remind our traders, our viewers that are participating in these markets, the WTI, the Brent, for example, that you're very susceptible to headline activity, right? Price swings ultimately. And we saw that obviously Sunday night into Monday morning. We're seeing that a bit here today. We're currently trading up 4% here right now as we speak, almost 4.5% in the crude. But it sounds like maybe not as much so in terms of RBOB, right? I mean, you get these big moves related to a headline move overnight, but maybe RBOB kind of has a little bit more of a level-headed approach towards some of that volatility that we see in the WTI or the Brent, for example.
Yeah, wholesale gasoline prices are very regional. We see them higher out west, where there are fewer refineries and a lot more demand with people doing a lot more driving. Along the Gulf Coast, where there are lots of refineries.
As well as some of the costs, expenditures that you mentioned as well, in terms of costs of producing some of the different blends.
That's right. That's right. And all that comes to an end starting first on the West Coast and moving toward the East Coast as we make the switch over to winter blends of gasoline. So demand, again, is playing into it. There's just a lot that has to do with the fundamentals. And I keep hearkening back to the fact, excuse me, that we're producing a lot of crude oil in this country, and we continue to do so. And you mentioned Iran earlier. That's going to be a key indeed going forward. The speculation that Iran had something to do with these terrorist attacks, we're still waiting to see if that's the case, but it really would have been counterproductive because there are already sanctions against Iranian oil. And there had been talk going back a month or two about the easing of sanctions on oil. We're still suffering from the supply cuts on OPEC Plus by OPEC Plus back in July, 3.6 million barrels. And it was thought that easing sanctions against Iran and getting perhaps 1 million barrels per day of that nation's production on the market would go a long way to easing the supply constraints that we saw as a result of those production cuts by OPEC Plus, and helping with the price of crude oil and ultimately the price of gasoline. It would seem awfully counterproductive for Iran to be involved in these attacks when they are suffering economically because of not being able to get their oil onto the market. And I've read reports that things as diverse as their airline industry, their commercial airline industry, is suffering as a result of the sanctions because they can't get parts for their planes. But there's also the economic hardship that their citizens are seeing as a result. So for all of a sudden for that shift to happen just seems very counterproductive on the part of that nation.
Robert, if that shift were to happen, we've been talking about the containment in terms of price activity. I would imagine that would shift some of that dialogue a little bit as well. Is that what we should be kind of watching here over the next week or so, next couple weeks, in terms of the broadening of this crisis and the spreading out of involvement?
Yeah, there is no oil and gas infrastructure in Israel and the Gaza Strip. But if this crisis, this unfortunate situation would have spread very nearby, you have Saudi Arabia, you have Kuwait, you have the United Arab Emirates.
Yeah, could get
you
messy
have
quick.
those. Yeah, you've got those key waterways too of the Persian Gulf and the Strait of Hormuz. You mentioned earlier about rumors leading to bumps in the price of crude oil. I remember going back some years ago that a terrorist group threatened to mine the Strait of Hormuz, through which maybe 20 to 30% of the world's crude oil transits, and the price of crude oil jumped overnight.
Yeah.
Now, there was nothing behind that threat, and the market settled down eventually. We called it the fear tax back then, and I think we're seeing some effects of that right now. There is the worry that this crisis could expand. If that were the case, that could have an impact on drilling, refining, and distribution infrastructure in the Middle East. But so far that hasn't happened. And I think that's why we're seeing the price of crude oil stay within a pretty tight box so far.
One could argue that ripple effect in terms of drilling, the impact could have a wider spread one here in the U.S. as well, and a longer term one as well if this continues to play out over months and years, God forbid. But Robert, appreciate you joining us here, and it's a pleasure to have you on the show as always. Robert Sinclair Jr., Senior Manager, Public Affairs at AAA Northeast.